this is Rob Roy, and welcome to the Elliott Wave Options S&P 500 U.S. market update. I wanted to come back with another update before the election, as there's been a couple significant changes in the charts that I wanted to share with you. As a quick reminder, this will be your last chance to post a comment on any of our recent EWO videos so that you'll be registered for our drawing for 10 free quarterly subscriptions to our two primary strategy portfolios, the impulse strategy and the volatility strategy. Make sure you hit that subscribe button as well. The drawing will be held on Monday, and once we've verified the winners and notified them, we will post their names in the comments section under the next video. All right, with that said, let's take a look at the charts. As I mentioned in the intro, a couple interesting things have occurred since our last update that I wanted to share with you. First of all, in case you're wondering, this upward zigzag pattern that we've been talking about for seemingly weeks now is still qualified. Even the movement down in the last couple of weeks has not served to disqualify that upward zigzag pattern. What has become disqualified is that smaller potential zigzag pattern that we talked about might be a complex C wave in the larger zigzag pattern. As we shared with our subscribers in our insider meeting this week, on the B wave correction, here you can see that's 87%, which means that can't be a zigzag to the downside forming. It's just a flat, and we're likely headed down to that level of the 61.8% corrective level in that upward zigzag I just showed you, which we haven't even hit yet. But again, that's probably where we're headed. But this 320 level serves as not just the 61.8% pivot point, but also an area of support going back to June, July, and then we broke through it in August. So that's going to be a very important level to hold for that upward zigzag pattern to still stay qualified. If that gets broken, then we're coming down here. We're going to complete this wave 5, and the retracement back to the wave 4 will be the next step. And then we start talking about that super cycle high and where the 4 could likely be over the next months or years, basically. So that's a pretty dire forecast there, but we're not there yet. But I wanted to update you on that smaller zigzag. Also wanted to talk about the dollar. A lot of people on the financial networks have been talking about how poorly the dollar's doing. The dollar's doing fine. In fact, it's actually been moving back to the upside. Now, we still have this downward zigzag that's qualified here, but when you look on the smaller scale, again, Elliott break things down into degrees. Elliott liked to do that, and this is great for those that like to trade shorter term. This move here has corrected 70%. So that means this is not a smaller downward zigzag, and we're likely coming back up to test this level, which was a 50% corrective level. So the dollar's held in there really well over the last several months, actually. Looking at the 10-year bond, this is the DEES contract on the 10-year bond. We talked about this in the last recording as well. We have this really nice zigzag pattern here with a potential move lower. So that means that the prices on the 10-year are going down and yields and rates are going up. I've been mentioning to you that rates are going up. Now, a lot of you have asked, well, I don't look at futures. Is there a symbol that you can show that we can use to look and see bonds? So I thought I'd share that with you. So here's a symbol TNX. That's for the 10-year. And you can see this is now rates. Okay, so the futures contract is the pricing of the bonds, but these symbols are showing rates. Remember, prices and rates move in inverse proportion. So then we have a really nice upward zigzag pattern here in the 10-year, and you can see right at 100% extension. So that's a point of resistance. And we came back down, tested the previous fib level at 61.8, and we're right back to that 100% level, which means this is a crucial level on the 10-year. Smaller note here, notice this corrective C wave here with the descending triangle. Just always like to point those things out because this Elliott wave Fibonacci stuff is everywhere. Also wanted to show you the 30-year. We haven't looked at that much. The charts are similar, as you can tell, but also nearing a point that's really important. So right there, again, hit the 100% extension, back to test the 61.8. So rates are starting to move to the upside. How is that occurring? That means if rates are moving up, money's been moving out of bonds. And it's been moving out of bonds since the middle of August. You can see where it jumped to the upside. Well, that money hasn't been moving into the stock market. That's about where we peaked in the stock market. So where is the money coming out of the bond market going? Who's selling? Could it be the Federal Reserve is actually withdrawing some of that liquidity that they pumped in? They've secretly been taking money out. This would seem to be more than just the Federal Reserve not injecting further, but actually withdrawing. Or could it be China maybe starting to sell off some of their bond holdings? Something's going on there, and it's going to be interesting to find out. The big question is, how long is the Federal Reserve going to allow this to occur? Because rates moving up right now is not really what anybody wants, unless you're a financial institution, then you like it. But as far as the economy, that's not what we want. So the Federal Reserve is going to need to come in with more quantitative easing or some sort of program to begin buying bonds again. The Federal Reserve isn't even big enough to control the bond market, but they can certainly influence it. So let's take a quick look at the VIX before we wrap things up. Obviously that we didn't have this larger potential descending triangle. We've broken up and we broke above that high from back in September. So that's literally the breakout of this smaller pattern that we had. And we also had a little bit of a trading range for a while right into this area. So there was just all kinds of consolidation patterns that were forming here on the VIX that makes sense with this upward breakout. We've leveled off here around the 40 level on the highs, but I still like to look at the 10-day moving average, even on something like the VIX. You've heard me say it, no security in any time frame gets very far away from the 10-day moving average. We've been a bit high, overbought, if you will, on the VIX, on the volatility. 10-day moving average is catching up. So we'll see how that plays out at the beginning of the week. Obviously, we have the election on Tuesday. We'll be back to report to you how the market handles that. One last note, there was a big spike up in the market. You know that the market was down a lot bigger than this on Friday, where the close in the last 20 minutes, and it was volume too that was coming in. Now, those were buy on the close orders. I don't necessarily think that those were buying moving into next week, likely just short covering moving into the weekend, people not wanting to be short moving into the weekend, not knowing what could potentially come out, especially with the unknown of the election. But boy, the beginning of next week sure is going to be interesting, and I'll be back to tell you about it. Hope you have a great weekend. Happy Halloween. Talk to you soon. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.